Joining us from the Chicago Board Options Exchange, Pat Kernan of Cardinal Capital Management. He actively trades in the S&P 500 options pit. Also with us, Charles Bobrinskoy. He is Vice Chairman and Director of Research at Ariel Investments, where he helps to oversee $6 billion in assets. Earlier this month, he told us that stocks are on sale, and the S&P 500 has fallen about 2% since then. So let's start with you, Charlie. I mean, is it cheaper and a better buy? It seems like we've got a couple people on Friday and today saying this is the time when you want to get in there.
In the short term, it's a voting machine, and right now people, unfortunately, are voting by taking their money out of mutual funds. And you also have institutional investors who are more inclined towards alternative investments, and then you have corporate pension plans that are doing more fixed income investing. So right now, unfortunately, there have been people taking their money out of the stock market. It hasn't been a problem of corporate earnings. It's been a problem people taking their money out of the market.
Hey, Charles, it's Dominic here. How much of this is a change in investor psychology? We heard Brendan Lothry talk earlier today about how the individual investors gotten scared, kind of gotten rattled a bit here, and that's why there's this huge inflow into bond funds. How much longer can that last?
Especially retiring baby boomers, right?
It's generational. It's going to be demographic, right, Charles?
No, that's exactly right. And I'm really actually petrified about what's going on in the bond market right now. I think, you know, we haven't seen flows into one asset class like this since the tech bubble, when there were such massive flows into tech stocks. Buying these bonds, some of them which are 2.5% corporate bonds, to me makes no sense. So I really am worried about a bubble there.
Although a bubble can collapse, right? And I mean, as long as you're an investor who's going to keep his money in there, that you eventually get it back and they pay you a coupon, it's got to be a bit of a different story.
Yeah, but over 10 years, if you buy a 2.5% bond and that interest rate goes to 5%, which is not hard at all, you can have the face value of your bond go down by 30%. So I am nervous here about what people could think they're getting in safety when they're really not.
And Pat, I want to bring you into this discussion. Looking forward to tomorrow's numbers, how key are they? I mean, if we see big drops in the housing market, does that bode horribly for the equities market, since we've had so many big names talk about the drop in housing that could bring us back into a recession?
Well, it kind of feels like right now any numbers that come out negatively or even mediocre seem to get investors skittish. Right now we are seeing low volumes. We're seeing less people putting money to work, especially in the options right now. Basically, I think a lot of it is people are just pretty scared right now. You kind of rewind the clock back to May, and you see the flash crash, which is a bad thing, obviously, for the market in general. There's a lot of volatility. It scares off a lot of people. You don't have the average investor wanting to put money to work because they're afraid, you know, they could lose a lot of money in a day. So as it is right now, it feels like any number that's slightly negative does have a large impact to the downside.
Is it the kind of fear, and let me ask you, Charlie, we were talking with Tobias Lefkovich from Citigroup earlier, and he was saying this is the kind of fear into which you want to buy, that old Benjamin Graham, Warren Buffett cliche, but is it the truth?
Absolutely. I mean, I wouldn't feel that way if valuations were high, but they're ridiculously low. You've got high-quality, large-cap stocks trading at some of their lowest multiples since the 70s. You've got a higher dividend yield on J&J than a government bond, which is just ridiculous. You've got great value here, even in depressed earnings. So, yes, you don't want to necessarily buy when people are afraid if the earnings aren't there, but the earnings are there and the values are there. So this is absolutely a right time to buy.
Hey, Charles, it's Adam. When you say ridiculously low, it sounds like you're talking about some pretty specific names. In other words, for the market as a whole at 14 times, I mean, that's not ridiculously low, and that could get cheaper.
Well, 14 times. The S&P is, I think, at less than 14 times. I mean, I don't know what people have different estimates for the S&P, but I think large cap quality, we would put it under 13 times. You're right. There are some more cyclical names that are trading at higher multiples, maybe 14 times trailing. But going forward, I'd put the overall market at something like 12.5.
That's right. Just for the record, 14.2 times trailing, 12.8 times forward-looking. Dom, did you have something to
Pat, I mean, we keep on talking about this S&P 500. You do it with the options out there. Is there any kind of range you're looking at right now? Should investors be kind of putting money? Is this like the bottom end of a channel or a trading range? Or is there a better opportunity down the line, perhaps?
Well, it definitely feels like, given the order flow that we've seen over the last couple of days, it definitely feels like we're going to be a little bit range bound. If you look at the volatility index, the VIX, it's trading a little bit right around unchanged today. Basically, what that's telling us is that people aren't really seeing a big move in the S&P for the next couple of weeks. It's probably going to be slow going into the Labor Day. You see a lot of people are on vacations. They're not really putting money to work. As far as for going out through the rest of the year, right now we're taking a pretty neutral stance. If we see the S&Ps drop down below 1050 in the S&P and closer to that 1025 level, that's where we kind of are starting to feel like it's probably a good time to start looking at getting in.
Hey, Charlie,
I would just jump in on this and just quickly say it's very dangerous to try to time something like this. There are all kinds of studies that have shown that you can easily miss a lot of the upside move if you get too cute here. I would advise against people trying to time this too finely.
For investors at home, right? Because it's Pat's job to do that every day.
Right. That's right. He's a professional trader, but the rest of the people at home should not try to time this.
Well, Charlie, I would ask, though, I mean, is there an argument that you would make to people that they should get in now? I mean, given what we have seen in the market, why not just wait until the fall when we have some more certainty, whether it's one way or the other? And I'm talking here certainty about the elections, about economic data, and maybe the next wave of earnings as well, because you say the earnings have held up well, but some of the more recent numbers, like Cisco, for example, have not been quite as encouraging.
So something like, first of all, once it becomes certain, it will already be in the stocks and they'll have already moved. The point is that over 70% of the companies that have announced their second quarter numbers have beat expectations. 70% of the stocks actually have a higher estimate than they did 3 months ago. So this is not about companies missing earnings. It's about fear. You guys are absolutely right. Investors are very much afraid of the volatility. It's not pleasant for anybody, but over the long run, the value of stock is not based on what's in people's heads. It's on what's in their wallets.
But it's also, I mean, Julie makes a very good point as far as November, right? Because you don't know what capital gains tax is going to look like next year. You don't know what dividend tax is going to look like next year. You don't know if there's going to be a death tax next year. I mean, there's a number of uncertainties without obviously even bringing into it income tax and either a market-friendly stimulus or a stimulus that the market doesn't like.
So let's say there's a higher income tax. Does that argue for putting your money into corporate bonds versus stocks? Absolutely not. Those corporate bonds are taxable. The wonderful thing about stocks is that most of the appreciation you get at a Johnson & Johnson is tax deferred. You are paying a tax on the dividend, but you've got all of your gain coming over the long run from that appreciation coming from the reinvestment of those profits.
Now, Pat, it's Dominic here. Here's the thing. Charles brings up a great point about the corporate bond thing here. But with the S&P 500 owning stocks right now, is there a reason why people should be just owning stocks outright? Or is it better for them to look at, more conservative ways to play? Perhaps hedging with a buy-right strategy, something like that.
Well, that's actually what I was going to say to Charlie's point. Yeah, there is a lot of volatility right now, but you can use that to your advantage. When you look at the volatility index, when it starts getting a little bit higher, it is usually a good time to do a buy right. You can take advantage of the high premiums you want to get in. It kind of protects you a little bit. If you do see a bit of a downside move in the market, you're giving yourself a cushion by selling either an at-the-money or an out-of-the-money call, and you collect a little bit of premium in the meantime. On the flip side, if you're an investor who does think you want to put some money to work, you want to get involved in the market, you want to get long some stock, but you still fear that 10% down move could happen, you may go out, you might buy a protective put and try and cap out your losses on the downside.
All right, Pat, thanks so much for joining us. Pat Kernan there of Cardinal Capital Management, Charlie Bobrinskoy of Ariel Investments. We appreciate it.